What's going on, everyone? My name is Obi, and welcome back to the Courtside Financial Podcast, the podcast where we break down business and technology from the courtside perspective. Now, I know what you're all thinking. Obi, where was this video on NIO's earnings yesterday? Well, here's the thing. When NIO dropped their earnings from Q2 2025, I could have rushed to get a video out for you guys and give you a hot take. But that's not how we roll over here at the Courtside Financial Podcast. I'm a NIO bull. I'll be the first to admit that, but that doesn't mean being blind to what's actually going on. So I took 24 hours to let these numbers marinate, to digest the community's reactions and give you an honest assessment or be as objective as a NIO bull could possibly be. So that's what I want to provide for you today, because that's what you deserve. So today we're diving into NIO's Q2 2025 earnings, the community's reaction, and what this all means for the road ahead. So grab your coffee, settle in, because we're about to break it down. All right, so let's start with the headline that had lots of people panicking. NIO reported a net loss of $697 million for those keeping score. Now, before the Bears start celebrating, let me give you context, the context that actually matters. This is actually NIO's smallest loss since Q4 2023. We're talking about a 26% improvement quarter over quarter and a 1% improvement year over year. But here's where it gets interesting, and this is why I wanted to wait a day to talk about this. The community's reaction has been, well, let's call it colorful. I saw someone's comment that said, haha, real mature analysis there, right? But I also saw someone say opportunity to load more. Hooray. This is exactly why we need to look beyond the surface numbers. Here's what caught my attention, and quite frankly, what should catch yours if you're serious about understanding the business. NIO's R&D expenses dropped by 6.6% year over year to 3.01 billion rent. Now, for a tech company, reduced R&D could be concerning, but dig deeper, and NIO explains this is due to being at different stages of the product development cycles and reduced depreciation. Translation: they're being smarter with their money. Their adjusted operating losses narrowed by 1/3. Let me repeat that, 1/3 improvement in operating efficiency. That's not accidental, that's systematic cost control. And here's the kicker, while R&D went down, they still managed to deliver 72,056 vehicles in Q2. That's a 71% jump quarter over quarter. So they're spending less and they're delivering more. That's the kind of operational leverage that gets me excited. But now let's talk about what has the NIO community buzzing, and I mean really buzzing. The Q3 guidance of 87 to 91,000 vehicles implies that September deliveries could be anywhere from 34,000 to 39,000 units. If NIO hits the high end of that range, we're talking about a new monthly delivery record. And based on July's 21,017 vehicle deliveries and August 31,005 vehicle deliveries, they need to deliver almost 39,000 vehicles in September to hit their Q3 guidance. One community member said it perfectly. Only thing that matters right now is how quickly they ramp up the L90. And he might not even be wrong about that. Here's where I think that the market is missing the forest for the trees. NIO isn't even just NIO anymore. They've got NIO, they've got Onvo, and they've got Firefly. During their earnings call, management revealed some fascinating details. The Onvo L90 is gaining serious traction, so much so that order intake for August hit a new high for the year. That's brand momentum that's translating into actual demand. And here's something that should excite every NIO investor. They're targeting 150,000 vehicle deliveries for Q4. That's averaging 50,000 vehicle deliveries per month. To put that into perspective, that's more than double their current run rate. Okay, so now let's address the elephant in the room. NIO has been promising profitability for what feels like forever, and the community, well, let's just say that their patience is wearing thin. I saw one comment that really struck me. If you're a long-term investor, you're practically down 80%. Cheering for this management team is pathetic. That's what they said, not their words, not mine. Ouch, but also not entirely unfair. However, and this is a big however, NIO's guidance for Q4 is actually quite specific. They're targeting 16 to 17% vehicle margin, sub 10% SG&A to sales ratio, 20% gross margin on the L90 and ES8 models, and all of these things should lead to their first quarterly profitability. Now, I've seen William Li make promises like that before that didn't pan on schedule. But here's what's different this time. Their operational improvements are already showing in Q2. The expense control is real, the delivery momentum is building. I spent way too much time reading through community reactions yesterday, and to your surprise probably, it's better than cable TV. Let me share some highlights with you guys. There's the eternal optimist, a person who said NIO shares will reach $150 eventually. It's just a matter of time. Their words, not mine. And there's the realist, someone who's having an existential crisis. He says, I lost 30K on NIO. I was stupid to ever re-enter again. Now 3K down again. My worst investment ever. I think about it daily. And my personal favorite exchange was about the technology. Someone had claimed NIO's technology was better than all of their rivals, to which someone had responded, ever heard of a company named Tesla? But you know what? This diversity of opinion, it's actually healthy. It means that the market hasn't reached consensus yet, which typically presents opportunity. Here's something that got lost in all the financial noise: NIO's technical achievements. One community member made a point that I think is underappreciated. They said, the fact that they can squeeze a huge trunk, large booth, while still retaining battery swap capability for Firefly, L90, and ES8 without sacrificing performance and internal space clearly shows something about NIO's technology. Look, I know that battery swapping is controversial and critics say that it's expensive and limited, but NIO has 388 service centers and they're expanding rapidly. They've solved the chicken and egg problem that kills most infrastructure plays. And here's the thing about network effects. They compound. Every swap station makes the network much more valuable. Every new NIO customer makes the network much more sustainable. During the earnings call, NIO dropped some interesting guidance about 2026. They're planning to launch the ES9 and an updated ES7 model, but notably Firefly won't get a second model and the core lineup won't see any major updates. That's going to be the ET5, the ES6, the EC6. This could be smart resource allocation or concerning stagnation depending on how you look at it. I'm leaning towards smart resource allocation because I think that it allows them to focus on scaling existing products rather than spreading themselves too thin. Their quarterly R&D budget for 2026 is projected to be 2.5 billion rent, which maintains innovation capacity while also showing cost discipline. Now, I promise you guys objectivity, so let's talk about what the critics are getting right. One particularly detailed criticism caught my attention. They said, William Li promised 450K annual deliveries in 2025. 2025 will end at very best with 350,000 deliveries, 1/3 less than the claim. That's probably accurate. NIO's 2025 projections look optimistic at best given the current run rate. And so the critic continued, it's a NIO pattern. Product deadlines, delivery guidance, profitability timelines, all repeatedly overpromised and underdelivered every single time. Harsh, but of course historically valid concerns. However, here's where I think the bears missed the mark. They're applying linear thinking to an exponential business model. Yes, NIO has missed previous targets, but the infrastructure investment phase, it's different from the scaling phase. You might be transitioning between these phases right now. Let's talk about something that should concern every NIO investor: the balance sheet. NIO ended Q2 with 27.2 billion Ren in cash and equivalents. That sounds healthy until you realize they had negative shareholders' equity and current liabilities exceeding current asset. The company says they have sufficient resources for the next 12 months, but 12 months isn't forever. This puts real pressure on the Q4 profitability target. It's not just about proving the business model anymore, it's about financial survival now. After letting these numbers and community reactions marinate for 24 hours. Here's my honest, objective opinion, as unbiased as a NIO bull myself can be. NIO is at an inflection point. The operational improvements in Q2 are real. The multi-brand strategy, it's showing early traction. The path to profitability, it's clearer than it's ever been. But, and this is crucial, these next 2 quarters are going to lay the foundation for what NIO can become. It'll show people, is NIO seriously a contender that should be regarded in the same vein as Tesla, or are they going to become a cautionary tale about over-promising and under-delivering? The Q3 guidance is aggressive. The Q4 profitability target, it's ambitious. If they hit both, NIO transforms from speculative growth company into a profitable EV company with some unique technologies and of course expanding market share. If they miss on either, whether you're a bull or a bear, the investment thesis becomes a lot harder to defend. So here's what I'm watching for going forward. These are going to be the metrics that I'm keeping my eyes peeled for. September delivery numbers. We need to see 35,000 plus to validate Q3 guidance. Onvo L90 production. This is critical for the mass market strategy. Gross margin progression. The path to 20% needs to be visible. The cash burn rate, how long can they sustain these losses? The market reception of the refreshed ES8 launching in the end of September. These aren't just numbers, they're the building blocks of whether NIO's bold promises can actually become reality. Before we wrap up, I wanted to highlight one community comment that really resonated with me. There's no point in being a skeptic on this earnings. Management is doing all the right moves. Fundamentals are stronger. For long-term investors, dips are welcome. NIO's Q4 profitability milestone will reflect in the Q1 2026 earnings, but until then, we may have turbulent market pricing. I think this captures NIO's investment thesis perfectly. For the bulls, if you believe in the company's long-term vision, then all the volatility is simply just noise. If you don't believe, then no quarterly result will convince you. The key is knowing which camp you're in and following the rules of the road, essentially. So why did I wait 24 hours to make a recording? Because immediate reactions are usually emotional and wrong. I'm trying to take the emotion out of it as best as I can as a NIO bull. Hot takes usually age poorly, but my thoughtful analysis, I think, will compound well over time. NIO's Q2 2025 earnings weren't spectacular, but they weren't catastrophic either. They were progress, messy, imperfect, but directionally correct progress. The real test isn't whether NIO can report decent Q2 numbers. It's whether they can execute on their Q4 profitability promises while simultaneously scaling 3 brands in increasingly competitive market. That's the story we'll be following for the next 6 months, and honestly, I'm excited to see how it unfolds. That's a wrap on today's deep dive into NIO's Q2 2025 earnings. Remember, this is Courtside Financial, where we break down business and technology, oftentimes the Chinese EV market and NIO. I'm biased, but with the respect that it deserves. That'll be it for this episode. If you found this educational, insightful, entertaining, at the very least, make sure that you like the video, click the notification bell icon, leave a comment down below, share the video, whatever you guys can do to help out the channel and engage with this. It really does go a long way in helping us get to a broader audience and serve more people. Nothing I said in this video is investment advice. It's all opinion and entertainment based. So do your own research and come to your own conclusions before making an investment in anything. Anyways, that's it. I'll catch you guys in the next installment. Obi signing off. Goodbye.